about a second option. We can say, well, option 2 is to again give each company 40 permits to pollute, but to say, well, now you can trade them on a secondary market. What this means is that you have this initial endowment of permits, but you can actually buy and sell them to other companies. So the first question then becomes, well, who's going to buy and who's going to sell? The answer to that depends what the price is. So let's think about the willingness to pay and the willingness to sell by each of these companies. On the willingness to pay side, we say, well, how much would each of these firms be willing to pay to buy a permit rather than reduce pollution itself? So, well, if it costs firm A $20 to reduce pollution by 1 unit, so it would pay up to $20 to instead get a permit, because if it's cheaper to get a permit and keep polluting, it's going to want to do that. So the willingness to pay for firm A is up to $20. Similarly, for firms B and C, firm B is willing to pay up to $25 for the right to pollute, because up to $25 it's still cheaper to buy the right than to stop polluting. Firm C is only willing to pay up to $10, because it only costs firm C $10 to reduce pollution by 1 unit. On the other side, we can say, well, at what point are they going to want to sell these permits? Because you remember, they each have 40 of them to start with. Well, firm A sits there and thinks, well, it only cost me $20 to reduce pollution by 1 unit. Hey, if I can get at least $20 for this permit, I'll sell my permit and actually reduce my pollution a little bit. Similarly for firm B, so it will cost me $25 to reduce pollution by 1 unit. If I can get at least that on the market for this permit, I'll just reduce my own pollution, sell the permit, I'll be better off. Same for firm C, where firm C is willing to sell these permits if the price is at least $10. So now that we have the willingness to pay and the willingness to sell for each of the firms, we can say, well, what does our supply and demand look like? And we can actually construct a market for these permits and figure out how they're going to trade, who's going to buy and who's going to sell. We decided that whether a firm wants to buy or sell permits depends on what the price it can get for those permits is. So let's think about some different options here. So if the price is below $10, well, pollution permits are pretty cheap. Everybody's going to want to buy them. The question is then, how many do they want to buy? Well, firm A here is polluting 70 units. Well, he was given 40 permits, so he's going to want 30 more. Firm B is polluting 80 units, also was given 40 permits. He's going to want 40 more. Firm C is polluting 50 units. He's given 40 permits, he's going to want 10 more, for a total of 80 permits being demanded. Now the problem here is that collectively they want 80 permits that they don't currently have, but nobody's willing to sell them. So we get an imbalance here between supply and demand. Because demand exceeds supply, that means that the price is going to get driven up. So you can say, well, what happens if the price is between $10 and $20? Well, in that case, it's still cheaper for firms A and B to buy the permits than to clean up themselves. So you say A and B are still going to want to buy the permits. So their demand is going to be 30 and 40 respectively, like here. We're going to have a total demand of 70 permits. C now wants to sell the permits, because they say, well, it only costs me $10 to clean up. Hey, if I can get more than $10 for these permits, well, I'll sell the permits, clean up, and make a profit. So we've got C selling the permits. Well, it has 40 permits available to sell. So we still see that demand exceeds supply. We're going to have the price get bid up some more. If the price is between $20 and $25, we'd see now B is the only one that still wants to buy permits, because it's the only one where it's still more expensive to clean up than it is to just buy the allowances. A and C are going to want to sell the permits because they can do better cleaning up and selling the permits than they could by just cleaning up. So now we get an imbalance in the other direction, in that we have a supply of 80 permits, but only 40 wanting to be purchased. Taking the last extreme here, at a price above $25, everybody's going to want to sell their permits, and they have 120 permits available to sell, but nobody's going to want to buy them. Because in that case, it's cheaper for everyone to clean up themselves rather than to buy the permits. So what does this look like in terms of a supply and demand diagram? Well, unfortunately, it gets a little bit weird looking because we have these breakpoints where firms go from demanding 0 to demanding 20, 30, 40, some discrete amount like that. So you get something that looks a little funny, but in general, we have an upward sloping, roughly speaking, supply of permits and a downward sloping demand for permits. They meet somewhere in the region here. Unfortunately, because this overlap is just not one single point, we have a little bit of a gray area in terms of what actually happens in terms of market outcome. We said that the tipping point between where demand was greater than supply and supply was greater than demand is at a price of $20. So let's think about what happens if the price of a permit is exactly $20. So if we think about it, firm A here, because it costs firm A exactly $20 to clean up, he's technically indifferent between buying, selling, and doing nothing. He's happy with whatever. Firm B specifically still wants to buy 40 permits because he's polluting 80 and he only currently has 40 permits. C still wants to sell 40 permits. So it stands to reason that we can sustain a market outcome where the price is exactly $20. C sells 40 permits to B, and A stands around and doesn't do anything. So now that we know what the market's going to do, we can calculate the costs for each of the firms when trading of permits is allowed. That's shown here. You'll notice firm A, well, they don't get any revenue or costs from engaging in permit trade because they're not doing any of that. So they're just keeping their 40 permits and then cleaning up 30 units so that they're within the government regulations. It costs them $600 to clean up 30 units, since their cost for cleanup is $20 per unit. So they have a net cost of $600. Firm B is buying 40 permits at a price of $20 each, so they're spending $800 on the permits. But once they buy the 40 permits, they have a total of 80 permits, and they were only polluting 80 units, so they don't have to now engage in any cleanup. So their cleanup cost is 0. So their net cost is $800. Their only cost was that of buying the permits. Firm C, well, they're the ones selling the permits to Firm B. So they're getting revenue from the permits in the amount of $800. So this $800 goes here. But now, because they've sold all their permits, they're polluting 50 units and don't have any pollution permits. So they've got to clean up 50 units. Well, it costs them $10 per unit, so their cost in total to clean up is $500. But it's costing them $500 to clean up, but they're getting $800 from another company. So they're actually making out like a bandit here, and their net cost is actually negative $300, meaning they're profiting by $300 compared to where they were before. You'll notice here that I put the cost without the trade alongside the new cost just to make a point. So here, Firm A is indifferent between whether or not he's allowed to trade the permits because he doesn't want to trade the permits anyway. But you can see that Firm B and Firm C are both strictly better off being able to trade the permits as compared to not being able to trade the permits. And that's reflected in the total cost of the cleanup to the system here. When you allow trade, the total cost is $600 plus $800 minus $300, which is a total of $1,100. Whereas with option 1, we saw that the cost was $1,700 to the system.